Welcome to this edition of Stock Market Pulse. My name is Eric, and today is Wednesday, December 14th, 2016. And be sure to visit our new website at www.stockmarketpulse.tv to get my next trade of the week email, and don't forget to subscribe to this channel. So let's look at what happened today. We're still about 20 minutes before the close. Obviously, the big news event is that the Fed decided to raise rates. This was pretty expected. I think the hawkish thing that came out, they expect to have 3 rate hikes this year, which is maybe one more than expected. I don't remember exactly how many they predicted for 2016, but this was only one this year, and I think they had 2 or 3 also. So, we take what they say with a grain of salt. Obviously, if things turn for the worse, they're not going to hike anymore and could possibly lower. Anything can happen. But it was a little bit of a hawkish sort of tone out of them for the Fed announcement today. But what I wanted to look at is what I think is interesting is, first of all, the market already knew that the rate hike was coming. It was pretty much baked into the cake, and the market's been rallying the entire time ever since the election here. The fact that the market got the expected announcement of them raising rates, the prices are baked in here a little bit. So we are down a little bit. We have recovered off the lows. If we take a look around, like the dollar continues to rise, but the dollar knew they were going to do the rate hike. You actually have the NASDAQ relatively flat on the day, so it's very choppy. What I wanted to do is sort of compare last year's rate hike and what happened in the following week. So let's do that. So I'm going to zoom out, and I'm on a 1-year chart of SPY, and this dotted line here, that's today, and this line is the last rate hike, which was, I think, was December 15th, 2015. So almost within a day of each other a year ago. And so let's zoom into this side of the chart here. So when the Fed raised rates for the first time in however many years it was, the market actually rallied a little bit and then kind of sold off because, again, it was probably baked in. And then when we got into the first of the year, January 4th, we had that huge plunge, right? So, and that's kind of what I'm expecting, not really the plunge part, but I'm expecting over the next couple weeks, the rest of the year, that we kind of just chop around, and maybe we get a little higher, maybe we get a little lower, but I don't know that we're going to get too much action until the first of the year. So if we sell off in the beginning of the year, which I think is totally possible, I think it probably doesn't happen here. There's a little bit of tax rumblings that if Trump can lower the corporate tax rate, there could be some selling at the end of the year so people can sort of book their profits, if you will, so that they'll get the lower rate because it could be retro. I'm not an expert in that, but that's some of the idea of why this market over the last week has not sold off. It's slowed down a little bit, but people might be wanting to book these profits with the idea of a lower tax rate. So I'm not making any trades based on that, but that's just some of the stuff on the stream. So again, the last time the market hiked, we chopped around a little bit, we sold off and ultimately recovered, and we're making new highs. So let's look at some of the other asset classes as to what they did during that time. First thing I want to look at is the dollar. And this is very, similar to what we're seeing today. The last time they hiked, the dollar had a big rally. It went to new high, I guess and then it kind of, again, chopped around and then fell off. Now, this is more February. The market already dipped in January, and the dollar was kind of come around, and then it sort of fell off. Typically, a rising dollar would hurt gold, but let's take a look at gold. This is kind of interesting. Last time, gold initially pushed lower, found itself a little base, and then started a huge rally. If we zoom back into today, again, gold is selling off, but if we start to trade sideways and stabilize or put in some kind of sideways action, I would actually look to bet on a gold reversal heading into next year. So, we'll see what that looks like. Like I said, the market already knew that the Fed was going to hike rates today. And yeah, we're getting a little bit of move here in gold to the downside. Doesn't really make sense that gold is down. The spiders is down, and bonds. If we look at TLT, bonds are down. Everything's down basically, barring a few exceptions. But I think it's very interesting that even though higher rates means a stronger dollar, you can see that gold had a huge 2016, right? A huge move, almost a 30% move. Now it's fallen off in the second half of the year, but if that continues, if that pattern continues, then we should, at least if anything, the rate hike isn't going to affect gold, I guess is where I'm headed with that. So let's take a look at a couple other ETFs real quick, what they did last time. Financials, they actually sold off. And so this is actually concerning for the market because the XLF just had a huge run and they're so overbought up here. So yeah, even though the Fed's going to hike rates, meaning the banks could make more money. However, it ultimately rolled over here and the banks just sat in like stagnation for the entire year, right? Just kind of flat to sideways after the recovery. And as soon as, rate hikes are on the table, it rallies. So to me, the rate hike was baked into the cake. I don't think financials go much higher. Yeah, they could go a little bit higher, but I would be taking profits up here and waiting to see how January looks to play out. So that's it for this video. If you want to get the trade of the week that's coming out this Friday, don't forget to go to www.stockmarketpulse.tv and get on the list. I'd love to hear your feedback, so please comment on this video and give me a thumbs up if you found this was helpful to you, and we'll see you at the next video.